Hey, good morning and welcome to Class 45 Fair Market Value. I'm Jeff Cait. I have a cold and I can't wait to tell you what we came up with this week for y'all. I think this is amazing. Um, Steve called, dental specialist. He's selling his practice and he said, change my beneficiary. Processing the form without analysis, he'd be $900,000 out of pocket. With proper structure, he gets 350,000 cash today and keeps the 4 million of life insurance in his investment company. The difference, 1.25 million. The primary driver of the math, fair market value calculation, the numbers that matter, calculations you need to know so you can share with your customers. So let's go. What you're buying, what your client actually owns. It's not the cash surrender value, it's the fair market value. Steve's holding statement, million of cash value. Steve's actual ownership, $2 million, fair market value. Different numbers, different consequences. Here it is. When a shareholder removes corporate policy, it's taxed at fair market value, not the cash surrender value. That's section 148.7. Shareholder benefit. Here's his holding statement. We look at cash like, bond like, equity like components. He has no term left, but he still has his bond like components, and we do the values. And if you look down here, these are the numbers you need to have. If you notice right at the bottom, $1 million of each of these policies is the estimated fair market value of this property. What happens here is the fair market value calculation we should know so we can help our clients. What it is the present value of the death benefit minus the present value of the costs, 5 inputs, present value math. Training doesn't cover this for the advisor. So here's how it works. Here's a calculator. You're welcome to it. It's a ballpark fair market value calculator using the present value approach. It's going to be accurate, not 100%, but there's so many variables in here. So the first thing you do is you input the person's age, and then you say, oh, how long are they going to live? I put 25 because he's healthy. He's 65. That takes him to age 90. We know the insurance amount at life expectancy between these two policies is about $4 million. No more deposits are required. And then we calculate almost $2 million is the fair market value. We could change something like life expectancy. And if he's in bad health, that value goes to $3 million. Are you surprised? We shouldn't be, right? So here's product design trade offs that you need to explain. Fair market value is what your client owns. Cash surrender value is additional collateral. It's what the company's offering them to let them off the hook for the death benefit. But cash surrender value comes at a cost. It's a measurable cost, death benefit cost. Show me your math. Here's the math. Here's an example. Same allocation. Here's for this situation, we're doing $1 million allocating 50,000 per year for 20 years on a male 45 non-smoker. The companies have two options. They have the estate version of par and they have the wealth version of par. If we project them forward to life expectancy, what we can see is there's going to be a cost somewhere between 200 and 700,000, 640,000 is the cost of the early cash value. Consumers should know that. It's lost to the family. Now we talk about bank financing. And you know what? What you weren't taught about bank financing. And we want to do this. We don't want to kill the death benefit, but we've all been taught that cash surrender value is the collateral for bank financing. It's wrong. It's incomplete. Let me show you the whole story. Okay. Here's what actually happens with bank financing. Every loan must be repaid, typically repaid, in our case, by the tax-free death benefit. Any surplus death benefit after repaying the loan, that goes to the beneficiaries, usually the family. So the more death benefit, the better. Second key point, banks accept any acceptable collateral, not just life insurance cash value. You got an investment portfolio, you got real estate, you got business assets. Whatever the bank accepts works. This means you don't have to maximize early cash value to use bank financing. You can design for maximum death benefit instead, and this changes everything under holistic planning. And it all starts with understanding what you actually own, the death benefit, which has a fair market value. Here's the professional shopping framework. Someone who designs these products like an actuary, who knows the math, who understands profit margins. This is how an actuary who knows life insurance would shop for fair market value, not the cash surrender value. Allocate, diversify, deploy the sweeteners, calculate what they own. And here it is, simplified. I go through the steps. Number one, this is called the diversified portfolio approach. It's a process to optimize. We determine the allocation amount. That's up to the consumer. I'm not spending their money for them. They diversify across products and companies. We research the market, determine highest expected fair market value per allocation dollar over their lifetime. We pay attention and we use the sweeteners. That was class 37. To reduce the net cost, we have to be aware of ways to improve their return. And we focus on the death benefit, health status, and fair market value, not the cash surrender value. So thanks, class 45 of 50. Here's what we got. A bunch of slides. I haven't added the slides to it, but what we know is there's 5 calculations consumers need. They got to know what they're buying, which is fair market value, not cash surrender value, which is typically higher. We calculate it, present value death benefit minus present value cost. The statement that they receive won't show it. The one that you receive, it won't show it. The product design impact, cash accumulation reduces the death benefit. We can show the differences. Access without surrender, bank financing. Secondary market uses fair market value in the US. We should know what that number is, even though we don't have an organized secondary market for selling these products. And we shop for value. We diversify. We calculate ownership. We understand the trade-offs. In Steve's case, 1.25 million difference by understanding the fair market value. The statement showed he had $1 million, but he owned $2 million. That's a big gap. That drove the tax calculation. So I say, know your number. Your advisor probably doesn't calculate it. Let's talk about it now. Do you have any questions? Can't wait to talk about this one, guys.